Good afternoon and welcome to FBN Charting Points, a technical look at ag markets. Today is October the 24th, 2023. We're going to talk a little bit today about canola and soybeans and some of the related markets. We're going to get a little bit into the grains as well, corn and wheat at the end of the presentation. But we're going to focus largely on oil seeds to start this off today. Just going to get myself set up here. We're going to read a little bit of a disclaimer here. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only and is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability is therefore expressly disclaimed. Past results are not necessarily indicative of future results. All right. I have been hearing quite a bit of concern in the marketplace around canola. So I did want to start there. I will say that our position here at FBN, our FBN farm position, as we like to call it, we are 50% marketed for this crop year. That's what I would consider a very neutral position, right? We're half sold, we're half with 1 foot into the category that might show risk. It's possible that some of our clients, if they are positioned as such, are starting to feel some nervousness around this market. I think that's justified. We have been seeing some weakness that was not expected here, or at least that breaks below some previous support lines, and that may be getting some a little bit nervous. I understand that there's also quite a bit of nervousness around those who are maybe less than 50% marketed. I know some other advisory companies are closer to the 20% mark, and you may be feeling a little bit nervous at that point. I could definitely understand that. I think that a small position like that would be inappropriate in this marketplace, and I think you are keeping yourself open to too much risk if that's the case. I would recommend. It's hard in these markets when we see downward to act, particularly if we are under marketed, because our thought pattern, of course, is that soon as we make a marketing decision, that the market is going to turn around and go up, and that is a very definite possibility in this market. I can't say that is for sure what's going to happen, but it's just kind of how the saying goes, right? The day you wash your car is the day it starts to rain, and I think that's probably the fear and some of the hesitation about pricing in here. If that is the case, and you are feeling nervous and you're looking to act in this marketplace, I wouldn't hesitate. But I'll put a big caveat in there. I want you to make sure that you have some upside participation potential in this marketplace. So there are almost every elevator company in Canada here offers some kind of over-the-counter way in which to participate in upward markets. Some of them call it floor pricing. Some of them call it minimum pricing. There's a variety of options out there, and some grain companies are better than others. Also, if you are working with, say, FBN brokerage, there are options available for you there as well. And when I use the word options, I don't mean just exchange traded options. I mean there is marketing opportunities for you using brokerage as well. So I would highly encourage you to speak with your broker about some of those risk management strategies. But if you are in the camp where you're at that 50% marketed level, I don't necessarily think that there's too much to be concerned about here. What I do feel, though, is that some of the expectations about the top end of the market for the rest of the marketing year are getting taken down. So if we look at some of these areas here, right, likeliness of the market moving back to test this 800 to 830 area starting to decline. The market coming up, and this is now probably going to be strong resistance here. We have the 20-day moving average as strong resistance. I think any farmers who are undersold and are looking for a bounce to sell are going to sell into the bounces that get into this range, into that 7 back towards 700 and back towards 730. So we could see a bit of a prolonged weakness in this market, even as it comes out of seasonality. before we start seeing anything higher than even this 730 area. And we are talking about the January now. I've kind of taken the November off of our talking points at this point. So that's something to keep in mind. There's also the possibility that this is not seasonal weakness and that we are seeing fundamental weakness in this market, and that we are moving towards an assumption or a structure where we're looking at, maybe 19 million tons of canola in Canada instead of 17.4, which is what Stats Canada is predicting right now. I think the general consensus is that there's more. I think the number is marching closer towards that 19 million ton mark, and that might be putting some fundamental pressure in canola markets specifically. I do want to also kind of caution this, now that we've broken this 61.8% Fibonacci level up here, and we've broken this previous low. It did kind of come back and close in the mid-range of today's trading range. The opportunity to move down to this 620 level is very real. There is no technical support left in this market now until you get down to 620. So I do want to make you aware of that. I'm not saying that this market is runaway bearish and that it is going to do that, but there is little in the way of technical support in this market left. I want to go backwards now. I do want to show you a little bit of the November because it is kind of a similar story, right? And we are seeing the November peel off quite considerably, more so than we are the January, which does signal that the demand for acute canola delivered into the system right now is low. And it definitely signals that they're trying to push sales off into further months. So there is incentive to sell into further months. There's pricing incentive, and that pricing incentive over the last week or so has gotten more aggressive. So how we show that is in the yield curve here, and this up here is last week's yield curve, and it did already show a carry, but now we can see that particularly in the front month November here, that carry is starting to get a little bit steeper. But once you get out to the March, those carries are about even to what they were a week ago or so. So what it is telling us is that the front few months here are getting heavier as far as supply being pushed on the market, and the buyers are signaling they do not want the product as much in this November to January, or even into the March period, as they do March forward. So we still want to leave bullets in the gun. I do also understand that there are some advisory services that are going higher than 50%, 60, 70%, even on their sold recommendations. I think that might be a reaction towards the risk that is apparent in that move that could take us down into the 600s or low 600s. But I do want to keep some bullets back in the gun for March forward business. And I wouldn't be opposed if we saw a rally to getting into that 60% mark, but I do want to leave some product available to be able to be cash sold as we move forward in the calendar as well. Because we're not out of the woods yet as far as tightness in the canola supply. And if we do get down to low enough levels where to start incentivizing exports, then we could see a bit of a turnaround as well. So, however, all the charts that I've shown you so far are generally skewing towards bearish. And just wanted to point that out, that at this point, this isn't a bearish or a bullish looking market in any way. But it's how you position yourself inside of these markets that matters. And I think it's much more appropriate to be around 50% marketed than it is to be down at the 10, 20, 30% marketed level. So if you want to cover off some of your risks and you don't want to give up upside potential, again, talk to your advisors. They are aware of what is available out there in the marketplace as far as over-the-counter contracts available from elevators. And of course, they can help introduce you to, if you're not already working with an FBN brokerage account as well. So yeah, have a conversation with your advisor. That's a very important thing. One other thing here on the canola, just wanted to kind of showcase this here. This is cash prices, and I have Canadianized these. This is FOB Vancouver cash prices right now is trading about 727 or so. This low here is that low $600 futures level. So we are seeing a very similar pattern in the cash market on the FOB level as we are in the futures level, but we haven't broken below um, some of those lows just yet. So just wanted to point that out as well. All right, some of the it's not just canola that is looking heavy at this point in time, and I did want to point that out because if we're just looking at, say, Canadian fundamentals or Canadian pricing structures, it doesn't tell the full story. So I wanted to go through some of these as well. One of the reasons we are seeing weakness in the vegetable oil complex is because of soybean oil. We kind of talked about this in past reports and in past videos, but soybean oil, even today saw some significant losses. It is now pushing below that 61%, 61.8% Fibonacci. It did so yesterday and continued to trade lower today. So that is still weighing on the market. Of course, we're going to talk about soybean meal here. But again, what's happening is we're seeing a large soybean meal rally. It's incentivizing crush to be booked. And that means that oil gets put onto the market and sold as well as the meal. So there is a bit of a glut in available oil to be bought as a result of crushers booking up extra margin because of the rise in soybean meal. So we'll get into that in a second as well. But that is what the soybean oil chart looks like, which does look very similar to the canola chart, very highly correlated here. So I think that we are still in a period of time where we have to keep watching soybean oil for clues as to what happens in the canola market proper. Also, Euronext rapeseed is also seeing losses. Now, it's a similar story, except that a lot of rapeseed in Europe gets used for biofuel. And there are some demand concerns there as well. I just wanted to kind of pull out, I know this isn't a chart, but I did want to kind of pull out a headline here. EU imports of rapeseed are down 39% this year so far. Their major importers are Ukraine and Australia, and you can see that the share, what's happening here is we're the lower amounts of Ukraine, but Australia is picking up the slack with their larger crop from last year as well. So Australia is a dominant player in the rapeseed market as well, but overall, European Union is also importing significantly less. So there is a bit of a demand destruction story happening in the European Union, which of course is the largest importer of canola and rapeseed. The canola and rapeseed market as a whole. Looking at Canada specifically, we did see a big pickup in farm deliveries. This, of course, is data that is delayed. We do see a bit of an uptick here. So, depending on how aggressive it is, that could be an explanation why we're seeing some declines in the canola market as well. However, it's probably not just deliveries that would matter, but sales as well that don't get delivered. So, forward contract, even if it's forward contracted for, 2 weeks out, 3 weeks out, 4 weeks out, it still may not show up in the stats as deliveries, but there is selling pressure that might be happening in the marketplace as well. Unfortunately, there's no statistics, other than volume of canola futures that would showcase that. But it could be that there is a bit of selling pressure from the farm gate as harvest gets wrapped up completely and there's just, more confidence in what's in the bin. Exports are still pretty dismal as well. Now, we did clock in the last week of reporting. We did clock in the largest export number thus far this crop year for canola at just over 200,000 tons. As you can see here, last year during the same week, it reached 400,000 with an average of about 250 to 275. So it's not behaving as good as it could, and not that the market is expecting big exports out of canola, but I think this is even disappointing to some degree. We may start looking at the point where what we need now here. Maybe I'll move to the crush discussion here right away. Crush is operating really well. I mean, last week, I think this was 93% of capacity utilization. This here was 97, really good week here. So, anything over 90 is really good crush capacity utilization. This is the capacity utilization here. So this isn't a problem. It's not Crush is not the problem, but the problem with Crush is that it's finite in its ability to, we are adding a little bit of extra capacity this year. We have some capacity off a couple years into the future. But right now, the capacity utilization, which is about 230,000 tons a week, is running in the, in the low to mid 90s with this one particular week running 97. So crush can only do so much. And so if the crop is growing, as we mentioned, if it is growing into that, 19 or maybe even higher million metric ton level, in order to stave off growth of the ending stocks number, exports have to pick up, and we have not seen evidence of that happening yet. We haven't seen bargain buyers stepping in yet to do that, at least not that I have heard of, and we're definitely not seeing it in the statistics at this point. A little bit of a bright spot here, crush margins are increasing, and as I said, crush can only do so much, but this rise in crush margins from kind of when canola started to drop until now has been rising, right? So cheaper seed means better margins for crush, and we are seeing that here. There was a significant amount of business booked here in September, and then again in the summertime when these levels reached here. So I think that there probably is additional business being booked here, and that is a positive for the market at this point, because that means that there will likely continue to be business being booked as we go forward. If this margin had been falling, I think that would have been a really bad sign and a very bearish sign, and it might be speaking a little bit more dire about the canola market if crush margins were falling as seed was also falling. All right, just kind of going back to the chart here to talk about some strategy and some potential here. Again, the relative strength index is showing that we are in an oversold situation. Now, the last time, and I kind of put the crosshairs here on the last time we got into oversold territory, the rally was 2 or 3 days long and amounted to almost nothing. So just because the RSI is oversold doesn't mean we're going to see a screaming hot rally. I think if it does rally into this 20-day moving average area, for those that are severely undersold, I would definitely be getting some more coverage on there. And as we get closer to this kind of 720 mark, that might be another area to make some catch-up sales on as well. Again, the risk at this point, this is 617 down here, or close to 618 would be this previous low over here. As you can see, there's no support left in this market here. So the possibility of that trading down to this level is quite real. And so I think you should be having some discussions about where you feel you are appropriately marketed, knowing that is a potential, at least into this as we continue through the winter and fall, as the market looks booked up and the yield curve continues to steepen as we move through the calendar. All right, just looking at soybeans a little bit. As you can see, soybeans is a little bit of a different story. We did see a bit of a punch lower yesterday and a bit of a follow through today, but kind of rebounded back above $13 again into the close. This is the January soybeans. And just to kind of illustrate why that's happening, this is December soy meal, a screaming rally again today, bringing it up to 434 a short ton. That does best this previous high here at just in between 430 and 434. And we're moving up into that category in between 435 and 440, which would be the next level of resistance kind of up there. So this is a very bullish looking market. Argentina is essentially set to run out of beans sometime in November. And that means that there isn't, Argentina being the largest crusher on the planet, that means that the supply of soybean meal is going to become pretty scarce. And that's why we're seeing this rally in soy meal as well, and which is helping soybeans proper. The percentage of of the crush margin that is attributed to the soy meal is growing, whereas it's falling for soybean oil. They're inversely related. So this is what is holding soybeans up while the other rest of the veg oil complex is moving lower. We also saw some precipitation come out of the forecast. This is the 5-day forecast for Argentina. The big, where'd my marker go here? Okay, here we go. Ignore that red line, but here, the big soybean area growing is done here. That's Santa Fe, and we got Cordoba. In this area here is essentially the soybean growing area, and we've seen we saw some precipitation come back in. This area is very dry, particularly this northern area here. And there was some rainfall that was put into the forecast. There was some rainfall that fell this last weekend there, but this is the 5-day. It looks to be turning a little bit drier. They took some of this moisture out in the recent model run today. This is also our Brazil. This area here, which is getting pounded with rain, this is unwelcome rain in this area of Brazil. Up here is Mato Grosso, and that's a big agriculture producing area, Mato Grosso do Sul here as well. So lots of dryness still exists in this northern agriculture area of Brazil, and some of that precipitation was also taken out in the latest model run as well. So, overperformance of rain in the south, which is not welcome. It's kind of drowning the crops there, and not enough getting put into the model, or some being taken out of the model for the next 5 days as well. There still is some rain here, so there is opportunity for overperformance, but it did get lowered in the most recent model run. All right, moving into corn. Corn looks like it's going to come back and test this 470 area now. There was an attempt to run it above $5. I think the fundamental traders got a hold of it and said, why are we doing that? We still have over 2 billion bushels of corn in the US, and it started to sell off. We've broken back down below some of those moving averages that we were thinking were positive signs or a bullish sign. So we're kind of more into the bearish, neutral bearish territory now, with targets kind of potentially going down to those previous lows here near 470. Same thing with the wheat markets. We saw a rise, and it's starting to come off now. Chicago is testing that 20-day moving average. Again, this market is still sold relatively short as far as managed money goes. So there still is opportunity for a short covering rally, but there still needs to be a catalyst in order for those shorts to want to cover. And we're just not seeing that at this point in time. Kansas, of course, which is most susceptible to Black Sea prices, or particularly prices from Russia. We saw it move and test support again today. So it's still kind of flagging down below into the low end of trading ranges. And even the Minneapolis rally is starting to come off a little bit. So we could see another test back down into that 710 range. Again, just kind of wanted to update you on prices. We are seeing prices in Romania rise a little bit. We got 246 bid here. These are FOB Romania prices here. But the Russian values continue to fade. We're down now to 225 FOB in the Black Sea region. So, still a lot of pressure from Russia. Their crop size continues to grow via private estimates. USDA is a little slow to react, but lots of private estimates are increasing the size of not only the Russian wheat crop, but the Russian grain crop as a whole. Did want to talk a little bit about this is the Canadian FOB Red Spring. So again, there are some bids happening here for Canadian Red Spring. That is giving some opportunity. I know I've seen a lot of texts and things like that around some nice even number sales targets for wheat. Think if you're hitting those, that's probably a good idea. If particularly if you're under recommendations, which right now we are at 40% recommended level. We might be, if we can catch a bit more of a rally in this market, we might be looking for a place to get up to 50. But as you can see, the FOB prices are actually rising. So this is a bit of a different trend to what we're seeing in Russia. And the 13.5 protein out of Canada is getting slowly bid up on the coast, on the Vancouver coast at this time. Durham's a little bit of a different story. We've got falling prices in Saskatchewan. They are stable on the coast, but I think the elevator companies have did a good job of buying what they needed for their fall shipping period, and we're seeing some weakness in prices. So we may need to see, or may need to have some patience for the next round of demand coming for Durham at this time. All right, that's all we have for you today. Thank you again for joining us. I know it was a bit of a long one today, but we appreciate those who tune in. We will see you again on Thursday.